Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, June 24th. Middle East tensions suddenly wane after Iran opted for a symbolic retaliation that helped easing the worries that they would block oil and gas flows through the Strait of Hormuz. So energy prices are sharply down. The situation in the Middle East looks better this morning than it did over the past few weeks, but uncertainties remain still. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So, Middle East tensions suddenly waned yesterday after Iran fired missiles at a US airbase in Qatar, but having told the US that they would do so beforehand. As such, the missiles were intercepted. US President Donald Trump called the response week and announced a few hours ago that Israel and Iran have reached a ceasefire agreement. Wow, what a quick turn of events, right? Iran once again retaliated to show off without really retaliating to hurt. So tensions will probably ease from now if Israel also plays along. It is, however, quite uncertain right now whether there is a real ceasefire agreement like Trump claims there is, as apparently missiles continue to be fired across the border, and Iran said that they will actually stop if Israel stops, but Israel haven't said anything just yet. So in the energy markets, US crude tumbled nearly 10% at yesterday's trading session. Brent crude fell almost 9%, while Nat gas gave back nearly 5% on the escalation of the tensions in the Middle East and is drilling below its 100-day moving average this morning on waning worries that Iran will not block oil and gas flows that transit through the Strait of Hormuz. As such, oil prices retreated all the way down to the levels that they were trading at before the tensions between Iran and Israel started escalating earlier this month. We still see a certain rebound in oil prices and in the energy complex this morning on uncertainties regarding the ceasefire situation, but waning Middle East tensions and the hope that the worst is certainly behind us could eventually keep US crude's upside potential capped into the 200-day moving average and shift traders' attention back to the supply and demand dynamics in the oil markets, which include the acceleration of OPEC's production restoration plans and global growth prospects, which remain in favor of softer oil prices in the medium run. So if the market goes back to pricing the pre-Middle East tension scenarios, the barrel of US crude could very well sink below the $65 per barrel Fibonacci level and return back to the year-to-date bearish trend. If, however, tensions re-escalate, oil prices would spike again, but the geopolitical spikes in oil prices tend to be short-lived, as you see, and are interesting tactical plays rather than long-term exposure, and you should be very careful because the unwind is generally very rapid. Now, elsewhere, gold is softer this morning, and the US dollar, which has been amassing inflows from the rising geopolitical threat in the Middle East, is giving back gains aggressively, pushing the euro dollar above the 116 level. The dollar yen, on the other hand, is sharply down to the 145 level, while the Aussie dollar is back to the 65 cents level this morning. In summary, the FX markets and the majors are also pricing in the de-escalation of the Middle East tensions despite looming uncertainties regarding the ceasefire situation. In the equity space, the Chinese stocks are up today. The Nikkei index is also testing the highest level since February. European defense stocks yesterday rebounded from a dip as NATO countries will be meeting in The Hague today and tomorrow, a meeting that should eventually confirm the member countries' commitment to spending around 3.5% of their GDP on hard defense. So hard defense includes weapons and troops, and an additional 1.5% on defense-related investments that include stuff like cybersecurity and military mobility. But because the latter, so the military spending, the increase in the military spending is already fully priced in, the additional upside potential is probably limited for the defense stocks. The stock 600, on the other hand, slipped below its 50-day moving average and remains under the increasing weight of the lack of progress in trade negotiations between the US and the European Union. Indeed, the July 9th deadline approaches quite rapidly, and there is no news on the wire regarding progress. The major US indices, on the other hand, closed Monday's trading session in the positive territory, and futures hint at further gains this morning. Tesla, for example, jumped more than 8% yesterday as investors flocked back into the stock after the launch of the much expected robo-taxis went quite smoothly. While the Tesla robo-taxi is a major driver of gains since a while now, given that the EV sales at Tesla are not looking good these days, many experts out there still remain broadly unimpressed by Tesla's robo-taxis, highlighting that Google-owned Waymo's robo-taxis are already in the streets since 2018, and the company actually operates 250,000 rides per week, and that day, as Amazon's Zoox, which is another robo-taxi in competition, use a combination of cameras, radars, and a distance determining method, while Tesla's robotaxis use only cameras, which is cheaper but maybe not safer. But the reality is that Elon Musk is better at selling his products to investors, at least, and that's what counts for the stock price, right? So for now, the Tesla stock price is in a medium-term bullish consolidation zone. Anyway, zooming out, gains across US equities are supported by improved risk appetite and rising dovish Fed expectations, which actually pushed the US 2-year yield, which is a gauge of these expectations, deeper below the 4% mark. Now, this is important here because the Fed's hawkish divergence at the start of this year from the European Central Bank's dovish stance was one of the pillars of the US-Europe convergence trade, and the rising dovish Fed bets today, compared with the possible end of European Central Bank cuts, reverses a part of that convergence trade, or the supportive factors of that convergence trade. But Jerome Powell could still throw cold water on dovish Fed expectations at his semi-annual testimony that he will be delivering between today and tomorrow, as the Fed president will likely keep a cautious and a cautiously hawkish tone on highly uncertain trade and geopolitical setup of the moment, and will most probably repeat that inflation risks in the US remain just too elevated to consider cutting the interest rates anytime before fall. On the data front, yesterday's PMI data suggested a set of better than expected German PMI numbers, but combined to weaker than expected activity elsewhere in the Eurozone resulted in a set of weaker than expected Eurozone PMI activity for June. Numbers from the United Kingdom are slightly higher than expected. On the other hand, I guess they are having a sunny month of June out there because the sun is one of the major explanatory factors of the UK activity indices. But across the Atlantic Ocean, the US PMI data also printed a set of stronger than expected PMI figures in June and a surprise rebound in existing home sales, but the US existing home sales still see the weakest May since 2009, and uncertainties regarding the White House's tariff strategy persists as we approach the July deadline in tariff posts. So Donald Trump was supposed to let his trading partners know about their tariff verdicts. Remember that? So it was supposed to happen these days, but the Middle East tensions just diverted the headlines toward a more urgent geopolitical matters. Now, de-escalation of the Middle East tensions could eventually bring the trade negotiations and the trade uncertainties back to the headlines and eventually give a fresh direction to risk assets on both sides of the Atlantic Ocean and beyond. Note that tangible progress in trade negotiations between the US and the European Union is needed to keep the STOXX 600 afloat above its 200-day moving average. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.